In this episode of Ignite&Scale, we're thrilled to feature Doug Lawson, the founder of MarktoMarket, a pivotal figure in the realm of private company valuations. Doug's transition from a seasoned professional to an entrepreneurial leader has been marked by a keen focus on leveraging data to demystify the valuation process and access intelligence on small private businesses. As we navigate through the complexities and nuances of valuations in today's rapidly evolving markets, we aim to uncover the insights and strategies that propelled MarktoMarket to the forefront of this field. Doug, good morning. Really to kick things off, transitioning from your previous role into founding MarktoMarket must have been a significant leap. Can you share what sparked this shift and how your background has shaped your approach to valuations?
Yeah, sure. So as you alluded to, I used to, I got to know you when I was working as a fund manager, and I was at a place called Amasi, which I'd set up with Paul Jordan in 2009 or so. So we'd spun ourselves out of another organization to set up a boutique that specialized in smaller companies, and that was a sort of a 7-year period for me when we grew that business from, it wasn't actually a standing start. It was a we took a bit of money with us, so we had an income stream. It wasn't a very big income stream, but when we started, we had a wee bit of an income stream, and that allowed us to get going. And therefore, well, it did feel quite risky at the time because we weren't sure whether we'd be able to pay ourselves initially or not. And but the timing of that was actually really good because the markets, when we were doing the deal, markets were on their knees, and especially you'll remember, Mike, smaller companies were really, really beaten up, and then when it turned really hard, and we had that amazing rally in smaller companies, in the amazing rally in the markets, and smaller companies were sort of the biggest beneficiaries of it. And that was great because suddenly that small pot of funds that we took with us grew very fast, and then allowed us to attract some inflows. And then we were lucky enough to be given another mandate, a venture capital trust mandate, which sort of transformed us at that point in time. And I'm really grateful to the board of that VCT for giving us that, because that made a huge difference to us. And then we grew from there, and it's a case in fund management. Obviously, it's pretty difficult when you're small because nobody wants to give you, everybody or most of the asset allocators, they have their minimums, and they say, oh, you're too small. And I always used to think, well, that means we can buy anything. And not only that, we own the business, and all our personal capital is invested in the funds in the business. So I mean, you cannot get more aligned than that. But from a risk perspective, they didn't really like that. So you had to find the intermediaries that were willing to place, to take really small bets, and to which would allow you to grow to the next level and go to the next stage of intermediaries that could, you cross their thresholds and so on and so forth. So that allowed us to grow. And then in 2016, we sold just under half of the business, and I obviously stayed on after that, but after a while, I had this sort of burning desire to start MarktoMarket, and really that had come from a career of analyzing small companies, and before that working in M&A for a while, and really quite enjoying trying to understand the modeling aspect and trying to really get underneath the bonnet and understand the drivers of value in different companies. And yeah, I mean, you know this better than most, Mike. When it comes to a lot of the businesses we were investing in latterly, at Amati were public companies, but really small public companies with very limited coverage. Some had no coverage at all, and those are the ones I really liked because if you spend time analyzing those companies, that's where you might find a pricing anomaly there on the upside or the downside. But those are the ones I found really interesting, and I probably spent a lot of my time when I was analyzing stocks doing that kind of stuff, and of course there are lots of data platforms out there that help you analyze businesses, but they all have this gap at the smaller end of the market, and they have this gap at the smaller end of the market because data on the smaller the company is, the harder it is to find data on it, because it's not surfaced in the same way as data on large companies or public companies is surfaced. And what I did quite a lot of was getting, finding an interesting data point on, page 52 of the accounts, and then in another document finding another interesting data point buried away somewhere, and you start piecing it all together and it tells a story. And I guess that the sort of hypothesis behind MarktoMarket was if you could do that in a systematic way, you would be building a very valuable data set for anybody that was interested in investing in or advising in the small private company environment.
Yeah, I mean, I think, Doug, I remember your journey well at Amati, and I think you're very modest really in terms of how you built the business, because you were building a business whilst you were performing very, very well as well. And I think that was because you had an edge on the market and you looked at things differently. And then when I see your journey going into MarktoMarket, when we looked at all the systems when we started the fund as well, and I think, it really brought together private and public valuations very well, your system. But I find the insights and the data that's provided by your platform is really valuable to me as well. But could you discuss a particular challenge or learning curve you've encountered in developing the platform at MarktoMarket? Because I'm sure it wasn't plain sailing as any, developing any business isn't.
Yes, and sort of, I probably made it sound like that, the original vision is what has sort of transpired now, and and that's not the case. And also I think it's important for me to say we're not the finished article now. We're still on that, to use an overused expression, we're still on that journey now. But yeah, there were a lot of challenges at the start, and I think that again, I hope it doesn't get boring when I sort of used Amati as a reference point, but you can, with Amati, we knew instantly we had a product, if you like. You've got a fund and you've got investors in that fund, and so you have a product that is generating income for you. So that obviously de-risks things a lot. With software, you don't really know if anyone's going to buy it until you build it, and in order to build it, you have to invest a lot of time and quite a lot of capital. And I think that I always think about, some people call our niche data as a service rather than software as a service, because actually our product is the data and it's being delivered via software, but really it's the data. And so obviously, with a SaaS company, I mean, the sort of barriers and the cost to building a SaaS product have been coming down, which is great. So you can get something to market faster. But with a data product, you can't sort of you can't sell something saying, look, we just started collecting data today, and the database will grow over time, but do you want to have a go now? Because people just say, well, no, there's no value in that today because you've only got a day's worth of data. We need years of data so we could properly analyze stuff and we can look at trends and things like that. So we had to do a lot of that stuff, and I think that the other thing that I sort of wondered at the beginning, before I got together with my the guy who I run the business with, that I co-founded it with, he challenged me pretty hard on. I actually thought at the beginning there might be a retail market for the product. So, there's a lot more interest. Retail interest in private, and at the time there was a lot of crowdfunding was booming and all that kind of stuff. But actually, we pretty quickly realized that getting and there was a bit of a read across for this that we were keeping our eye on. We very quickly realized that actually getting retail investors to subscribe, to commit contractually to paying a monthly fee or an annual fee for something is just really, really difficult. It's B2C and it's so hard. And I get, we're all consumers, and we all know how the hurdles are personally for signing up to some kind of commitment like that. So we pretty quickly realized that actually this is not a retail product. This is a B2B product, and that's the market we need to go after, and therefore we actually need to displace, rather than selling something, rather than entering a market where people aren't using anything. We're entering a market where some customers were not using anything. A lot of customers were using one of the legacy products, and so we eventually got something to market, and inevitably it wasn't, and again I'm so grateful to those early customers, and but it wasn't the finished article, it wasn't perfect, but those earliest customers are still customers now, so they saw enough, it's like the classic early adopter stuff, and they saw enough value in it to pay us something for it, and they've seen the product change, those improvements being made over time, and initially the product was very focused around a valuation tool. So the initial product was really it was a database of deal multiples for small transactions. So the kind of sales pitch was, look, these are multiples you're not getting from any of the other platforms because we're collecting it at the smaller end of the market. And that means if you are accustomed to advising small bit, if you're a sell-side advisor and you're selling a 5 million revenue engineering business, in order to guide your client on the valuation of that business, you need comparable transactions of other £5 million, £2 million, £10 million engineering businesses, not Wood Group or massive $1 billion engineering businesses. So that was great. So the customers went for that, and that was fantastic. But what we realized was the other platforms that we were competing against, they were offering lots of other data sets alongside. So they were offering lots of other data sets alongside their deal multiples data set that were giving kind of additional value to the customer. So what the customer was sometimes saying was, okay, you're doing a far better job for us in terms of providing relevant intelligence on deal multiples, but this other platform that we have, it's helping us build buyer lists, it's helping us do origination work, it's helping us do market mapping, it's helping us find acquisition targets for our clients, it's helping us do all these other things, and you're just doing one thing. And we're a small business and we have budget. For some of them, it was a case of our budget stretches to one platform, and this other platform is solving all of these other problems. You're solving one problem really well, but it's only one of our problems, and we can't have two. So that made us realize that actually we had, from being our limited company is called MarktoMarket Valuations Limited, because that's what we thought we would be. But actually, whilst that's the core product, we had to expand the data sets. We had to build more data sets in order to solve these other problems for the customers, so that they could then get to a point where they could say, okay, now we can exit our incumbent provider because you're solving all of these use cases for us. And so that, that was one chart. Was actually, I don't think you'd call that a pivot, but you'd call it, I don't know what you'd call it, but you'd clearly call it like platform expansion. And it was going from solving one problem really well to recognizing that actually for these customers, they had 3 or 4 problems, and you've kind of got to solve all of them to have proper product market fit with them.
Yeah. I mean, I find that the product is really good on valuation and comparatives with private companies, small private companies, which I now look at, but also it gives you very good insights. You've got a marketplace of transactions, and it allows me to develop pipelines and keep that in one place where I can keep an eye on valuation trends as well. So for me, it's not just about the kind of valuation data. There's other applications, but if we reflect on the data and some of the trends that are coming out of the platform at the moment, how would you interpret these trends post-pandemic and maybe the impact it might have on future valuations? And I know the data is pretty granular in terms of regional variations as well, which I find really interesting.
Yeah, it is. What we try, so as well as obviously publishing all of the granular data on the platform, we produce for customers we call them indices, and it's really what these indices do is track how multiples are trending, how valuations are trending across different sectors. And the other really important thing is across different size bands. And because the multiple that is paid for, you've got 2 companies doing the same thing, but you would expect, all other things being equal, the company that's doing 100 million of revenue would attract a higher multiple than the company doing 2 million of revenue. So we produce indices that kind of show that and allow people to, if you want, you could say, well, here's a perfect comp, but it's 100 million, and if I point to the mark-to-market indices, I can see what the current discount is from a business of that size to a business of this size. So, and the reason we get that insight, Mike, is because not only do are we collecting all that, our analysts here collecting all of that information, but we're also asking our customers to submit kind of live, if you like, recently completed deal information. And so we can put all that information into the right buckets, and we can see how things are trending in real time. And the holy grail is trying to get to a point where you have the kind of valuation insight on the private markets that you do on the public markets, which is daily pricing, allowing you to to see trends in real time. We're not quite there yet, but we're trying really hard to bridge that gap. And so in terms of the sort of trends we're seeing, so what I think is quite interesting is you obviously have this situation where with private markets, you don't have the daily pricing, and you don't have people perceive there to be less volatility. And I'm not sure there is really. It's not visible because you're not pricing things on a daily basis. I don't think that necessarily means that that private company valuations are less volatile. It's just you don't have this daily look through to see that. And so what happens is if you look at the market, and I'll define the market for the purposes of this discussion as we have something called the MarktoMarket All Cap Index, which is sub 200 multiples of sub £250 million enterprise value deals involving a UK entity. So it could be UK company acquiring UK company acquiring international, or an international company acquiring UK business. There's some kind of UK stamp on it. And if you look pre-2020, if you look at that data for the year as a whole, that index has kind of tracked sideways amazingly. Now, if you start to look into the quarters, you start to see the volatility. But it's quite interesting when you put everything into the buckets for the years and you look at the all cap index, it's kind of trading sideways, and it's been trading just under 8, a median EBITDA multiple of just under 8 times. And that's everything under 250 million. So clearly you've got your nuances within there. And I'll talk about those in a wee bit. But what you've then got is in 2022, that multiple started to contract, and it's continued to contract into 2023. And what is where you can see a pretty strong correlation is the between the multiple contraction and the increase in interest rates. So if you look into the quarters, it was really Q2 2022 where you started to see those multiples start to contract, and the impact seemed to be particularly acute with sectors that are associated with high growth. like technology is the obvious one, and technology we define technology as that tech hardware, SaaS, and IT services. And within that, you got a big bunch of SaaS companies, fast growth, and therefore those future earnings are being discounted. But your if you want to think about it as the future cash flows, those fast growing future cash flows are being discounted back at a higher interest rate, and it's having that kind of disproportionate impact on the present value of those companies. So it sort of makes sense that multiples in the private markets from the middle of 2022 have been starting to contract. And then when you start looking again, you look under the bonnet and you go, okay, well, that's the market as a whole. What about like small companies v big companies, or the TMT sector versus the industrial sector, stuff like that? And that's where you start to see some really interesting stuff, I think. So what does appear, when we talk about this idea there isn't so much volatility in pricing in the private markets, what does seem the less volatile is down at the bottom end of the market. So we call it our nano cap index, and these are deals this is where we collect multiples on deals valued at less than 2.5 million quid, so the tiniest deals. And what's really, and that like trades like median multiple 4.5 times, something like that. And what's really interesting there is you see very little, you see much less movement in multiples in that area of the market than you do in, say, our mid-cap index, what we define as the MarktoMarket mid-cap index, which is 50 to 250 million pound deals. And I think that the dynamics at that smaller end of the market are just really quite different. These are predominantly owner-managed businesses, and the decision, the considerations for kind of exiting or selling or whatever are probably quite different to the larger end of the market, or where PE gets involved, where people are thinking about kind of more about the macro factors. At that smaller end of the market, it's kind of micro stuff. It's like, oh, I need to retire. I'm knackered. I want a break. I need to liquidate. I need some cash. It's that kind of stuff. Whereas as you get higher up the market, really different dynamics are at play. And also, I guess, down at that very small end of the market, there's less private equity. I know there's more money coming into that end of the market, with search funds and things like that. But there's still, it's like, I sometimes think about that kind of 50 to 250 million pound market. That's like, it's almost like stock picking if you're a small cap manager, it's like, you've got a universe of companies that probably all of the lower mid to mid-market PE firms, they all really know who those companies are. And it's about, you pick you pick the ones you like best for your portfolio. And that's where we've seen a more material compression of multiples, because, in that market, there's obviously more dependence on debt to get the returns, and obviously the affordability has been transformed by the increase in interest rates. You have other sentiment issues and so on and so forth. So as you move up our indices to the mid cap index, you've actually seen this sort of, funnily enough, you've seen this greater drop off in multiples in percentage terms. Although obviously buyers are paying higher multiples for businesses up there. And then so that's kind of the M&A landscape. And then when you look at a wee bit more into your world, Mike, when you look at kind of earlier stage stuff, when you look at the startup scale up landscape, so companies raising venture and growth capital, again the valuations there, we produce indices and we split that market up into the sub indices. So we have a pre-seed index and a seed index and a Series A index and so on and so forth. The pre-money valuations being paid at pre-seed and seed stage have remained reasonably consistent. At Series A stage, they've come off, and at Series B stage, they've come off materially. So it's almost like the larger the raise, the larger the business, the greater the pressure on pre-money valuations there. And I think it's probably, my theory is that if you've got a pre-seed or a seed business, you might have it might be pre-revenue, or the revenues might be very early, very embryonic, and therefore valuing the business on fundamentals is very tricky. Yeah, you can do your cash flow, but it's so speculative, and you can't really say, oh, that's a revenue multiple of 10, because there's nothing to hang your hat on. So I think in that market, it's like, well, how much money are you raising? I'm raising $1 million. Right. Well, we take 20% at this stage. So your pre-money's 4 and your post-money's 5. And that it's like, you know what it's like? It's like you don't want to, you want to, from having been on both sides of this, I now recognize that as an investor, you don't want to be too savage there, because if that company then needs to raise 5, another 5 and 10 and so on, you want the founders to be left with enough to be incentivized. So you don't want to say, oh, the markets are crap, so I'll give you 1, but I'm taking 90%, because it just kills the whole thing. So, however, it doesn't work. However, once you get up to like Series A, Series B, you probably do have, with most certainly in SaaS, you're going to have a relatively material number to apply a multiple, probably not at EBITDA level, but at revenue level, you're probably going to have a number to pin a multiple to. And therefore, you're probably going to say, well, look, multiples 2 years ago for Series A, SaaS, company with your growth characteristics and your TAM and all that kind of stuff, it was 10, let's just say. And I'm sorry, now it's 6. So that's your ARR. Your pre-money is 6 times that, and therefore that's, I think, why you've seen that greater pressure on valuations for later stage raises relative to the
I agree. Yeah, and I think there's a lot more co-investment as well, and there's a lot more dynamics on Series B. It might be 5 or 6 investors have to get together, and to get the deal done, there might be someone, it will always go at the lower price. So it's just a lot more complex. Whereas I guess early stage investors, it is Do you believe in the concept? Can you work with them to a certain point? And all businesses at a particular point in time needs a certain amount of capital to realise some of that ambition. So, Doug, it's been fascinating, and I could talk to you all day about these trends and the data that's coming out of your platform is I use it on a daily basis. It's hugely valuable for me. I mean, if anybody's interested in looking at your product, how would they get in touch with yourself or the team?
Yeah, probably the best way is to get in touch with me personally. You know, we're 30 odd people, but I'm really, I love talking to people in this market. It's one of the things that I love about the business, is speaking to investors, advisors down here. So get in touch with me, Doug at MarktoMarket.io. Mike, you'll give them, you'll pass them on, I'm sure. And yeah, just chatting to me in the first instance.
Absolutely.
Love to hear about what you're up to. See if we can help. And yeah, as you know, Mike, it's a pretty it's a bit of a fragmented community down here, and it's quite nice to join the dots sometimes. And you know, we as well as doing the as well as obviously the core business of the platform, we do lots of events as well. So even if you're not buying, if you want to come along to our events, we do those we're based in Edinburgh, but we do them all over the place. Then we can get you on the list for those events as well.
Very good. Well, I appreciate your time as always, Doug, and thank you very much for coming on.
Thank you so much, Mike. Really enjoyed it.
If you want to listen to more episodes of the podcast, we're on all good audio platforms. Our website is also www.cambriaprivatecapital.com, and you can also find myself on LinkedIn and Twitter, where we publish our weekly blogs as well. Please do get in touch if you want more information.